So guys, when it comes to investing, my wife's approach has always been, let's call it minimalist. As I'm sure you can imagine, she's not particularly interested in poring over 10Ks or reading The Intelligent Investor, but still, she knows that investing is important, especially if you want work to be optional at some point in your life, which I think we all do, and that's more than enough for me. I honestly couldn't ask for anything more than her understanding that and being willing to take action on it. Having said that, a couple of years ago, we set her up with a portfolio on Robinhood to, get her snowball rolling, and I will say, for the most part, since we set it up, that account has been pretty dormant. Every so often, though, she'll receive some Christmas or birthday money specifically earmarked for investing, which is kind of a running joke in my family, and I've talked about this before. This has been the case for me and my siblings ever since we were young, and now it applies to my wife as well, which I'm very happy about. But anytime there's a gift that needs to be given, whether it's Christmas or a birthday or anything else, my dad's favorite gift to give is money to invest, and so we put that into my wife's account, but beyond that, her investing journey up until this point has been pretty low-key until now. This is long overdue, but my wife and I are going to start actively contributing to this account, and in this video, I'm going to show you what her account looks like so far and what our plans are with this account moving forward. But before we get to that, I want to hear from you. Leave me a comment below and tell me about some of your investing plans and goals here in 2025. I'd love to hear all about them in the comments below. Now guys, going into this year, I wanted to transfer her portfolio over from Robinhood to Charles Schwab, which is done through something called an ACATS transfer. And if you're not familiar with this, it's a system that lets you transfer assets between brokerages. It's super easy. You basically just fill out a form and the brokerages handle the rest. Now, fortunately, Charles Schwab doesn't charge any fees for this, but Robinhood does. They charge you $100, which they pull from your account as they process the transfer. And with that said, you may be wondering, why the switch? What's wrong with Robinhood? Why not just keep it in that brokerage? And truth be told, I don't have anything against Robinhood. I think it's a very easy platform to use. That was the one that I first started using when I got serious about investing. And I like the fact that they let you buy fractional shares of any security as opposed to Schwab, which only allows you to buy fractional shares of S&P 500 companies. You can't even buy fractional shares of their own ETFs like SCHD, which I personally think is too bad, and I hope that changes in the future. At the end of the day, though, we're a Schwab family. This extends to my siblings and my parents as well. And going back to, getting money to invest for Christmas, my dad will literally drive still to the nearest Charles Schwab office, which is like an hour away from where they live, and hand them the checks to put into the accounts. So with that said, I wanted to stay true to that, and I just wanted to keep everything in one place. And so that was the main reason for the transfer. Like I said, nothing against Robinhood, but we're a Schwab family. Now, before making the switch to Schwab, most of her portfolio, probably like 70 to 80% of it was in VTI. So we can see here, she also had exposure to a handful of individual companies as well that she was familiar with, like Coca-Cola, Starbucks, Target, and Dutch Bros, as well as a couple other ones here. And overall, I think this was a pretty solid setup. The great majority of the portfolio was in a very well-diversified ETF. VTI has like over 3,600 different holdings. And then on top of that, we had those few individual companies as well that she knows and is interested in, which, could make investing more fun. But at the end of the day, if we're being honest, she really doesn't care about this stuff. Like I said earlier, she at least knows that it's important enough that she's willing to do it, or at least let me do it for her. But beyond that, she could really care less about investing. She doesn't want to spend any time thinking about this stuff, which is totally fine. And with that said, taking a look at this account's holdings over here on my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. I hope you check it out. But upon making the transfer to Schwab, for the sake of simplicity, I decided to switch things up and model this account after what I do in my Roth IRA, which is split between the S&P 500 and SCHD. Now, in my Roth IRA, the split is between VOO, which is the Vanguard S&P 500 ETF, and SCHD, but as we can see over here, in this account, I used SPLG. Now, really, at the end of the day, it's the same fund. They're both the S&P 500, basically, but the difference here is that SPLG is only about $70 per share, whereas VOO is over $500 per share. And based on the amount that we plan to contribute to this account moving forward, which I'll talk about later on in the video, it's just going to be so much easier to stack up shares of SPLG than it will be to buy shares of VOO. And normally it wouldn't make that much of a difference because of, fractional shares. But like I said earlier, Charles Schwab doesn't allow you 2 by fractional shares of anything beyond the S&P 500. So for our purposes, it just makes more sense to buy something like SPLG instead of VOO in this account. And you guys will have heard me talk about this before, but I'm a big advocate of this type of setup for anyone who wants to take a hands-off approach to building wealth. I think the split between these two, the S&P 500 and SCHD, really gives you the best of all worlds between share price appreciation, not to mention diversification, but share price appreciation, dividend income, and dividend growth. Unfortunately, my wife has heard me talk about this stuff enough over the years that she's very familiar with both of these. She knows what the S&P 500 is, she knows what SCHD is, she knows what both funds have to offer and how they complement each other. But anyway, now just looking at an overview of this account, we saw the holdings, but this is where things are currently sitting. The account's currently valued at about $1,400, and there used to be more in here, but a few months ago, back in September of 2024, we sold off some of the shares in this account to pay for part of the down payment on our home. So we did take a little step backwards here, but we'll build it back up from here in no time. Not a huge deal at all. And looking at the dividend stats, the dividend yield is sitting at about 2.25%, not too shabby, and the dividend growth rate is at about 8.3%. And at this point in time, based on these stats, every single year the account is bringing in about $32 of dividend income, which breaks down to $265 per month. But then moving forward, guys, as far as feeding this account goes, one of my goals by the end of 2025 is to increase the weekly contributions from $250 to $325 across all of our portfolios, my 2 and her 1, and I want that extra $75 to go to my wife's account before I increase the contributions again in mine. And combining all of these accounts, my 2 and then her 1, this is really going to beef up the growth of our wealth and our passive income, while at the same time giving us increasingly more exposure to ETFs. Now, as far as what this portfolio will look like in the future, based on her account's current value, dividend stats, and a projected share price appreciation of 7%, same thing for the dividend growth rate as well, and this may or may not be generous, we'll see what happens. This is what we can expect if we contribute $75 per week to this account. After 10 years, the account should be valued at about $62,000, not too bad, and every single year this account should be bringing in just under $1,400 of dividend income. Now, jumping forward another 10 years, so 20 years from today, this account alone should be valued at about $204,000, and every single year the dividend income should come out to about $4,500, not too shabby. And then after 10 more years, so 30 years from today, this account should be valued at almost $540,000, and every single year this account should be generating about $12,000 of dividend income, which breaks down to almost $1,000 every single month. And looking across the board, in my opinion, this is not too bad for only $75 per week. Now, if we add that to the projected growth of my 2 accounts, my taxable account and my Roth IRA over the years, based on my starting yield of about 3.6%, a share price appreciation and projected annual dividend growth rate of 6%, and the $250 per week I'm currently investing into my accounts, things start to look pretty crazy. And real quick, I meant to mention this a moment ago, guys, but all of these numbers that I'm getting came from the marketbeat.com dividend calculator. If you just Google MarketBeat dividend calculator, it's going to be the first one that pops up, but it's a really handy free tool. I highly recommend you check it out if you want to project the growth of your portfolio into the future. But anyway, looking at the combined results, all 3 of our accounts based on a contribution rate of $325 per week, moving forward, after 10 years, our combined accounts should be valued at $466,203. That's not bad at all, and every single year we should be bringing in over $16,000 of dividend income. Now, 10 years after that, after 20 years, we should be millionaires, which is going to be pretty sweet. Our account should be valued at $1.3, almost $1.4 million, and we should be bringing in almost $4,000 per month of dividend income. And then after 30 years, when I'm in my early 60s, if we just keep going at this rate, our combined accounts should be valued at about $3.5 million, and every single year, we would be bringing in over $120,000 of dividend income. Now, I don't know about you, but looking at these numbers and what can be with a little bit of consistency and a lot of time, to me serves as an important reminder of the incredible, magical power of compound interest. By continuing this process of investing, collecting dividends, and then reinvesting those dividends back into your portfolio, and then doing that over an extended period of time, you're creating what's called that dividend snowball effect, which is incredibly powerful. And that's what I'm telling you about in this next video right over here. With each reinvestment back into your portfolio, that dividend snowball just keeps getting bigger and bigger and bigger until it reaches a point where the growth of your portfolio truly becomes this unstoppable force. It's one of the coolest things ever. So click right over here to learn more about that, and I'll see you in the next one.